In this series of videos, I'm going to cover the basics for Chapter 9, Long-Lived Assets. Note that this PowerPoint presentation was originally developed by Scott Douglas, but I've made modifications and adjustments to ensure coverage of all the learning objectives. I'm going to cover all of the following learning objectives in a series of videos, including the following. Learning Objective 1, describe the classification alternatives for long-lived assets. 2. Describe the valuation models used for long-lived assets. 3. Apply cost and recognition principles to property, plant, and equipment. 4. Account for investment property. 5. Describe the accounting for biological assets. 6. Apply cost and recognition principles to account for intangible assets. 7. Interpret graphs and/or identify requirements for information systems. 8. Apply cost and recognition principles to account for goodwill. 9. Apply the revaluation model to account for long-lived assets. 10. Apply the standards for derecognition of long-lived assets. 11. Explain how long-lived assets are treated in the statement of cash flows. 12. Explain long-lived assets presentation and disclosure requirements. And 13. Identify differences between ASPE and IFRS related to long-lived assets. But before we start with Learning Objective 1, describe the classification alternatives for long-lived assets, we need to remind ourselves of what long-lived assets are. Long-lived assets, also referred to as non-current assets or long-term assets, are assets that are expected to provide economic benefits over a future period of time, typically greater than 1 year. Long-lived assets may be tangible, intangible, or financial assets. Examples of long-lived tangible assets, typically referred to as capital assets or sometimes as fixed assets, include land, buildings, furniture, fixtures, machinery, equipment, and vehicles, just to name a few examples. Examples of long-lived intangible assets, assets which don't have any physical substance, include patents and trademarks. And then examples of long-lived financial assets include investments in the equity or debt securities issued by other entities. Now that we understand what long-lived assets are, let's move forward with classifying long-lived assets. Long-lived assets are separated into 5 categories, starting with property, plant, and equipment, which are tangible assets, physical assets which you can touch, including land, buildings, furniture, fixtures, machinery, equipment, vehicles, just to name a few. These are assets which entities use to produce revenue by using the assets to help run the business. These assets are not intended to be sold because if they were, they would be categorized as inventory. Property, plant, and equipment can be sold when the entity no longer uses them, but their main purpose is to be used to generate revenue. The second category is investment property. This is land or buildings which generate revenue through rental income by renting the asset to somebody else, like owning an office building or an apartment which the entity rents to others. An example would be Ted Rogers School of Management, which is rented by Toronto Metropolitan University in Toronto, Ontario. The entity which owns Ted Rogers School of Management is actually Cadillac Fairview, and they rent it to Toronto Metropolitan University. Investment property may also be land which is held for future sale once the price increases, which is what capital appreciation means. The next category is biological assets, which are living plants and animals. Biological assets are discussed in Chapter 8 when they're classified as inventory, but they can also be classified as long-lived assets when they are used to grow produce, such as apple trees, which grow apples, or vines, which are used to grow grapes, which eventually will be made into wine. The next category, intangible assets. You already know that intangible assets have no physical substance. Instead, intangible assets are legal or contractual rights. Like tangible assets, intangible assets are not held for sale. Instead, they're used to generate revenue. They can be either purchased from another entity or they can be developed internally. Some examples include customer lists, copyrights, patents, subscription lists, mineral rights, franchise, computer software, licenses, and trademarks. A trademark, for instance, like Coca-Cola or McDonald's. Note that intangible assets must be separately identifiable. What does that mean? It means that the entity can separate the intangible assets from all the other assets that they own, and that the intangible asset can be sold, such as selling a patent or a trade name. The last category is goodwill. Goodwill is an unidentifiable asset, meaning that it can't be physically separated from the entity's other assets. Goodwill is created when one entity purchases another entity for more than the fair value of the net assets. But what does that mean? It's easier to use an example. Say Company A purchases Company B for $9 million. The fair value of Company B's assets is $2 million, and the fair value of the liabilities is $500,000. So the net value of Company B's assets is $1.5 million. Why would Company A pay $9 million for something that is only worth $1.5 million? It's because Company B may have something such as intellectual property or brand recognition or a foothold in the global market that Company A wants, and they're willing to pay for it. But the value of that isn't quantifiable, so they're willing to pay more than the value of the net assets. This is how goodwill is created. It's the difference between the price paid and the net value of the assets of the entity being purchased. In this case, the difference between the $9 million paid and the $1.5 million net value. Goodwill for Company A is $7.5 million. Remember, goodwill is not separable. Company A can't sell their goodwill because it's only there because of the net assets that they own from Company B. Really, goodwill is a hope. The hope that Company B's net assets will generate returns, will generate excellent earning potential well into the future. All 5 categories should be very familiar to you. They're the groupings that are used when we report long-lived assets on the Statement of Financial Position, also called the balance sheet. Note that I haven't covered financial assets, investments in the shares or debt issued by another entity. That's because that's a huge topic and it'll be the subject of a totally different chapter.